So, what if the next big global crisis isn't just another dip in the market? What if it's something more deliberate, like a controlled demolition of the whole financial system? Today, we are diving into a really compelling and, honestly, a pretty unsettling theory from Edward Dowd. He connects the dots between our massive global debt, the conflicts we see brewing around the world, and a fragility in our markets that most people don't see. There's a lot to unpack here, so let's get right into it.
And this is the core idea right here. The theory isn't that just one thing is about to go wrong, it's that we're watching a perfect storm form, a whole bunch of economic bubbles, all inflated at the same time and all threatening to pop. This one sentence really sets the stage for everything else we're going to talk about.
So, where do we even begin to peel back these layers? Well, let's start with the thing that's getting all the headlines right now: artificial intelligence. Is AI really the future, or is it a classic trap that we've seen play out time and time again?
I mean, you literally can't escape it, right? AI is being sold as the next industrial revolution, and the amount of money pouring in is just staggering. We're talking billions being thrown at this promise of world-changing technology. It feels huge, it feels exciting, it almost feels unstoppable.
But hang on a second. According to this analysis, this is a textbook tech hype cycle. Step 1, you get this frantic rush of investment, but with very few real returns to show for it. Step 2, companies overbuild. They set these completely unrealistic timelines. And the final predictable stage? Yep, the crash, when the money faucet inevitably gets turned off.
And we're not just talking in abstracts here. The argument is that some of the biggest names, like OpenAI and NVIDIA, are way closer to that final crash phase than you might think. And the proof? Well, we're already seeing signs of stress in the credit markets. The very first cracks in that shiny foundation are starting to appear.
Okay, so the AI boom might be on some shaky ground. But what if it's not just a one-off thing? What if it's just the tip of the iceberg? One piece of a much, much larger and more fragile puzzle.
So let's zoom out for a second. This theory suggests that AI isn't the problem, it's just the loudest symptom of something much bigger. They call it the everything bubble, a really unique time in history where pretty much every single asset class is dangerously overvalued, all at once.
And this is where that convergence idea really hits home. It's not just AI, it's the housing market, which is already showing major signs of cracking. It's private credit and private equity, both of which are stretched dangerously thin after years of easy money. All these bubbles are getting ready to pop, and the scary part is they're all connected. That creates a massive risk for the entire system.
So, what happens if these bubbles all start bursting at around the same time? The prediction is a stock market drop of 40 to 50%. And let's be clear, that's not a correction. That's a full-blown crash. And just to put that number into perspective for you, try to imagine the dot-com bust from the early 2000s and the 2008 financial crisis happening at the exact same time. That's the kind of scale we could be talking about here.
You know, this all raises a really critical question. Why? Why does this keep happening? What's the engine that's driving these repeating cycles of massive boom and then absolutely devastating bust?
Well, the argument goes deeper than just bad investments or a little market craziness. It points to a fundamental flaw in our modern monetary system itself, something the source calls an inflate-or-die system.
So what on earth does that mean? Well, basically, our entire global economy is built on a mountain of debt. And if prices start to fall, that's called deflation, the whole system is at risk of collapse. Why? Because the amount of debt you owe stays the same, but the value of your money and your assets goes down, making it impossible to pay it back. It forces governments to just keep pumping more and more money into the system to stop it from completely freezing up.
And this creates this unstoppable loop that we're supposedly trapped in. First, asset prices start to fall, which threatens the whole system. So, to stop a crisis, governments and central banks step in with massive money printing. This makes the markets bounce back, sure, but it also creates inflation and just plants the seeds for the next, even bigger bubble.
You've probably heard them talk about their tools, right? Things like quantitative easing. And yet, these actions might prevent a total meltdown in the short term, but the long-term price is currency debasement. Put it this way, the more money they print, the less each dollar in your wallet is actually worth.
But here's where the theory takes a really dark turn. It doesn't stop with just economics. It argues that these insane financial pressures at home have very real and very dangerous consequences on the world stage. It suggests that when the system gets this stressed, war becomes the ultimate distraction. The theory lays out a playbook that seems kind of familiar.
You look at Europe with a looming pension collapse and massive debt problems, that could push leaders toward a conflict as a sort of reset button. Then you look at China, dealing with a demographic crisis and a slowing economy. That could all be masked by cranking up nationalism and maybe even making a military move on Taiwan.
So you see this pattern emerging. When things start to go really bad at home, governments have a powerful incentive to create a crisis somewhere else. It rallies the people, it distracts from the problems at home, and it helps them hang on to power.
So, all of this, the converging bubbles, this insane inflate-or-die system, the geopolitical distractions, it all leads to one massive question. If the current system can't be sustained, what's the endgame? What comes next?
Well, the data might be giving us a pretty big clue. If you look closely, central banks all over the world have been buying gold at record rates. And according to this theory, that is not a coincidence. It's a strategic, coordinated move.
So what's the interpretation? That world powers are quietly getting ready for a major reset of the entire financial system. They're getting ready to shift away from the current system, which is based on US dollar debt, and maybe move back toward a system where a hard asset like gold plays a much bigger role.
So after all that, what are the big takeaways here? Well, first, holding some physical gold is positioned as a pretty smart form of financial insurance. But maybe more importantly, the idea is to completely reframe how you think about a crash. It's not just a disaster to be afraid of. For anyone who's prepared, it could be a massive buying opportunity, a once-in-a-generation transfer of wealth. And that really leaves us with a final, pretty provocative question to think about. In a system that seems basically designed to inflate until it pops, is that inevitable crash something you should fear, or is it the necessary, painful reset that creates the opportunity for a brand new beginning?
Okay, let's unpack this. We have spent the last few days just completely immersed in this staggering collection of sources. We're talking articles, research, deep analysis, and it all orbits the warnings of one person, Edward Dowd. And honestly, this stack of material, it paints a picture that's, well, it's both deeply alarming and, weirdly logically coherent.
It is definitely not light reading, but it's structured. You're right about that. The sources you provided, they really sketch out a world where this financial crisis we're worried about and all the geopolitical turmoil we're seeing, they're not separate events.
Not at all.
They are deeply, maybe even deliberately intertwined, like two sides of the same collapsing financial coin.
Exactly. So our mission today for you, our listener, is to give you the shortcut. We need to go past the headlines and really extract the core arguments, the major, and some are extreme predictions, and, crucially, those surprising causal connections.
The ones that tie it all together. Yeah, the ones that tie global conflict directly to the volatility in, say, your retirement account. It's about really understanding the mechanics of all this global uncertainty.
And I think we have to set the stakes right away, immediately. Because Dowd's central, most alarming prediction, this isn't just your garden variety recession or some modest market pullback.
Bro.
His whole thesis focuses on the convergence of multiple absolutely massive economic bubbles that he believes will lead to a 40 to 50% stock market drawdown.
40 to 50%.
Yes. And potentially within just a year or two of this analysis being published. And here's the really critical systemic claim he makes. While the financial system is crumbling under this pressure, global powers will simultaneously use conflict and external threats.
The crisis of distraction.
That's what he calls it. A deliberate mechanism to mask, to manage, and maybe even to monetize this internal collapse.
A 40 to 50% drop that's an incredibly aggressive forecast. That puts it squarely in the realm of 1929 or the dot-com bust in 2000, if not, worse.
It's a generational event. Absolutely. So what does this all mean for us? We're going to tackle this material in three big causally linked moves, basically following the framework that's laid out in Dowd's sources. First, the geopolitical rationale. We'll examine why the sources argue that major world powers see external conflict as a necessary, almost structural reboot.
Right.
Second, we'll dive right into the specific financial vulnerabilities, this convergence of bubbles that he says justifies that massive drawdown forecast.
And
finally, we will break down the underlying monetary system, the big one. The inflate-or-die trap that forces central banks to choose inflation over a total collapse every single time.
Okay, so let's start with what many of you listening might find the most cynical part of this thesis, and frankly, the darkest part.
That's a tough one to swallow.
It is. The argument is that major world powers are not moving toward conflict randomly. Dowd suggests it's happening as a calculated, almost deliberate attempt to distract from these deep, unmanageable internal crises.
Economic and demographic.
Economic and demographic, exactly. It's really the oldest trick in the political playbook. But the sheer scale of it and the fact that it's happening everywhere at once, globally, according to these sources, that's what's unprecedented.
That is a disturbing core thesis. It really is.
Yeah.
Because it suggests that the chaos we're all seeing isn't just, incompetence or bad luck. It suggests it's a systemic necessity.
Right.
And we know from history, right, from Rome to 19th century Europe, distracting the populace with an external enemy when things are going wrong at home. That's standard operating procedure. But our sources use two very specific, high-stakes, contemporary case studies to illustrate this point. And they start with Europe.
Yes, Europe's predicament.
Yeah.
According to this deep dive, it's being driven by internal rot, not just, because it's close to conflict zones. Dowd cites two critical, specific internal issues that are getting close to terminal velocity.
Okay.
First, an impending pension collapse that is just looming over several major economies, particularly in the Mediterranean and Western Europe.
Let's get a bit more granular on that pension issue, because impending collapse is, well, it's an abstract fear until you actually look at the demographic math. What are the sources saying is fundamentally broken here?
Well, the math simply isn't working anymore. The dependency ratio has completely inverted. When these systems were set up, you had, 4 or 5 workers for every one retiree?
A healthy pyramid.
A very healthy pyramid. Now, because of declining birth rates and these massive increases in how long we all live, we are rapidly moving toward a ratio where it's 1.5 or maybe even 1 worker for every retiree.
That's unsustainable.
It's mathematically impossible. Countries like Italy, Germany, they face unfunded liabilities in their public pension systems that are bigger than their entire GDP.
So what are their options?
Well, if the governments try to fulfill these promises without, massive politically explosive tax hikes or these draconian benefit cuts that nobody wants, the whole system just implodes.
So you've got that demographic time bomb ticking away. And on top of that, you have the second issue. Unsustainable debt levels. And it's not just the national debt you see on the news, right? It's the debt that's often hidden away.
Precisely. We are talking about debt that's been accumulated over decades, often masked through complex financial instruments, sovereign guarantees, off-balance sheet liabilities. You look at the debt-to-GDP ratios of several key European nations, they're hovering around 150%, 180%, some are even higher.
And servicing that debt, paying the interest, becomes basically impossible when interest rates go up like they are now.
Exactly. The debt cannot be paid back. It's too big. It can only be inflated away. But even that requires politically sensitive actions that leaders want to avoid.
So if you can't pay the pensioners and you can't service the debt in any politically palatable way, you have an unresolvable legitimacy crisis, which leads directly to this mechanism cited in the material. This is the shocking motivation that you, the listener, really need to grasp. Dowd claims that these insurmountable failures are pushing European leaders toward war as a form of reboot.
That phrasing, reboot, is so important. It's vital. It implies a structural necessary reset that's enabled by a crisis. So how does this reboot happen? Well, a major conflict allows governments to invoke emergency powers.
And that sidelines all the normal democratic processes?
Immediately. Public dissent, protests, all of it gets sidelined. And crucially, it allows them to restructure or even default on their debt under the cover of national security.
That is financial repression on a global scale. But how would a war specifically enable debt erasure? I mean, how does that work mechanically?
Well, historically, severe crises, especially wars, allow governments to do things they could never do in peacetime. They can impose capital controls, nationalize certain industries, and they can issue new debt that is often explicitly inflated away later, which renders the old debt nearly worthless.
So the financial slate is essentially wiped clean.
Wiped clean. Not through some orderly negotiation, but through a national emergency. It lets them impose the kind of austerity and financial controls that would be political suicide in peacetime, but they could frame it as a necessary sacrifice against some existential external enemy.
It transforms an economic failure, a failure to manage debt, into a narrative of national survival. It's truly fascinating and frankly horrifying context.
It is.
So let's move from west to east. The script is similar, but it plays out differently in China, which has its own massive, arguably even larger internal stress points. What are the economic and demographic pains cited there?
China is facing these twin crises that, they fundamentally threaten the state's central promise of ever-increasing prosperity. That's the deal they made with their people.
Right.
Economically, they're experiencing a significant maybe even historic economic slowdown, especially in their all-important property sector. The housing market, which at its peak was nearly 30% of their economy, has basically frozen.
And we're seeing companies like Evergrande and Country Garden just implode.
And they're not just going bankrupt. Their collapse represents a massive, sudden loss of household wealth and, critically, local government funding, which relied on land sales.
And you have to remember, property isn't just an investment in China. For most middle-class citizens, it's their primary savings vehicle. So if that wealth just evaporates, internal stability is severely compromised.
Absolutely. And then you have the other crisis, the demographic one.
The long-term killer.
That's the long-term killer. China is grappling with a steep and worsening demographic decline. It's the legacy of the one-child policy combined with modern low fertility rates. They're aging so rapidly.
And their working age population is shrinking.
Shrinking fast, while the number of dependents, the retirees, is soaring. This just fundamentally undermines their long-term growth model, which for decades has relied on cheap, abundant labor. The projection is that they'll grow old before they grow truly rich, which is a recipe for internal discontent and massive resource strain.
So the government in Beijing is looking at this massive economic contraction and an aging populace that expects the promises of prosperity to be kept. So how does Dowd allege the Communist Party handles this internal pressure?
Well, Dowd alleges that China is using intense nationalism and the potential threat of military action, specifically toward Taiwan, to mask or redirect attention from these worsening domestic issues.
It's a classic maneuver, but I'm still trying to connect the dots. How does the threat of military action specifically solve the internal financial or demographic problems? It seems like it would just drain more resources.
It serves multiple, very powerful political purposes. First, heightened nationalism. It fosters internal unity. It justifies increased state control over the economy and the flow of information. It frames any internal pain as a necessary sacrifice against some external historical threat.
And second,
and this is crucial, the intense focus on Taiwan and the need for military readiness allows Beijing to mobilize resources, divert public attention away from local economic struggles, like their apartment being worth half what it was, and use this external confrontation as the defining challenge of the era. It basically excuses the failures in the real estate sector or the lack of Social Security funding.
so that's the universal pattern, isn't it? If you step back and you synthesize these two massive examples, Europe grappling with the debt and demographic arithmetic of its welfare state, China grappling with the collapse of its housing market and the reality of a shrinking workforce, you just see the same conclusion. When economies falter or when that internal social contract starts to break down, governments reliably create external enemies to maintain internal control and unity.
It's incredibly effective because fear is a far more unifying, visceral emotion than economic grievance.
Yeah.
If you're struggling to make ends meet, you might blame your government. But if the government successfully frames your struggle as part of a grand national defense against an aggressor,
Suddenly you're on the same team.
suddenly you align with the state. The deeper the internal rot, the more spectacular, the more existential the external distraction needs to be. And the sources suggest we are seeing the world preparing for the most spectacular distraction possible.
So this geopolitical turmoil we're seeing, it isn't just random chaos. It's a predictable, maybe even a necessary side effect of massive unresolvable debt and demographic crises. And that sets the stage perfectly for the next section, because the reason this distraction is so urgently needed is the impending collapse of the financial foundation itself.
And now we transition
Yeah.
sharply. We go from global politics to global finance, because the financial system is the immediate cause of this entire crisis structure. Dowd's primary warning here is that we are not dealing with a single isolated problem like the dot-com bubble in 2000 or the housing crisis in 2008.
This is different.
This is different. We are entering a simultaneous convergence of multiple, highly leveraged, interconnected economic bubbles, and that dramatically amplifies the systemic risk.
And the source material, it breaks down 3 major bubbles that are all converging right now. And it starts with the one that affects every family and every local bank, the housing sector. So what's the observation on bubble number 1, housing?
The observation is that the housing bubble is, and this is the quote, beginning to unwind. We need to really unpack what that means beyond just saying, prices might drop.
Right.
Unwinding suggests a structural reversal. The initial stages, they entail rising inventory on the market, especially in those regions that saw the highest price appreciation during the pandemic. But the bigger pain point is the sharp drop in transaction volumes. High interest rates, now necessary to combat inflation, make affordability simply impossible for the vast majority of first-time buyers and really anyone who needs to move.
And we saw this in 2008. Housing trouble spreads very quickly beyond just residential mortgages. Are the sources pointing to commercial real estate, or CRE, as the critical systemic risk vector this time around?
Oh, absolutely. CRE is the slow-motion train wreck that everyone in finance is watching. Dowd's analysis points to the fact that billions, maybe trillions, in commercial mortgages are coming due, especially those tied to office towers and retail spaces that have emptied out post-pandemic.
And they all need to be refinanced in this new high-rate environment.
Exactly. So you have this combination of drastically reduced occupancy rates and the tripled cost of debt service. It means these loans simply cannot be refinanced. This puts immense localized pressure on regional and mid-sized banks because they're the ones that hold a disproportionate amount of this CRE debt.
And that's the mechanism. That's how housing pain becomes systemic financial risk all over again.
It's the same playbook.
And as we learned from past crises, when housing unwinds and the banks get stressed, it hits the non-traditional financial sector even harder. And this brings us to bubble number 2, where the systemic risk really starts to amplify: private credit and equity. How does Dowd describe the state of this sector and what makes it so dangerous?
He describes this sector as dangerously overextended. And for a lot of listeners, private credit might sound, abstract, but it's essentially the shadow banking system.
Okay, break that down for us.
Well, over the last decade of near-zero interest rates, much of the lending and the high-risk investment bypassed traditional, tightly regulated banks and moved into private equity funds, direct lenders, specialized credit vehicles, and these are often highly opaque. They don't have the same disclosure requirements as, say, a publicly traded bank.
So what are the specific systemic risks that are associated with this opaque, overextended private credit market now that rates have shot up?
The standards for lending were just. They were loosened dramatically when money was effectively free. Private credit was used to finance riskier ventures companies with high debt loads, highly leveraged buyouts, or LBOs, and businesses with, let's say, questionable profitability. And all of it was done under the assumption that rates would stay low forever.
Which they didn't.
Now, the debt burden on these leveraged companies becomes absolutely crushing. We are hitting what the industry calls the maturity wall, a massive volume of low-rate debt that was issued years ago that now needs to be refinanced today at rates that are 3 or 4 times higher.
And when those refinancing attempts fail, that's what triggers the defaults. And it's in a market that lacks the transparency of public exchanges.
Exactly. Private credit is illiquid and it's opaque. When the defaults begin, the true scale of the losses is not reported daily or even monthly. It can remain hidden for months, maybe years, inside these funds.
So it's a ticking time bomb.
It's a ticking time bomb of hidden, high-yield, high-risk debt. And this opaqueness means that when the reckoning finally arrives, it can trigger these sudden, sharp liquidity crises as institutional investors suddenly realize the true deterioration in their asset values.
Then we have bubble number 3, which we're going to deep dive into next, but we have to acknowledge its role here. The AI bubble, which is just inflated by these unsustainable valuations. So the convergence of residential and CRE housing stress, opaque private credit, and this extreme future price tech valuation. That's what leads Dowd to his truly dire forecast.
This is why the sources draw such a shocking comparison. He compares the current market fragility to the dot-com crisis and the 2008 crisis combined. And he argues this is not hyperbole if you understand the components. The dot-com crash was primarily a valuation crisis. Tech assets were just overpriced relative to any realistic earnings.
Right.
The 2008 crisis was a systemic leverage, and credit crisis assets were backed by layers and layers of bad debt. Dowd is arguing that this time we have both simultaneously. We have wildly overpriced AI and tech valuations and a dangerously leveraged opaque credit system that's fueled by shadow banking.
So that's a justification for the magnitude of the prediction. What is the precise, specific forecast that's derived from this combined fragility?
The prediction is highly specific, and it's based on the historical precedent for when bubbles burst in a synchronized way. A 40 to 50% stock market drawdown, predicted within a year or two. He is forecasting the market halving from its peak.
Wow.
Driven by the synchronized bursting of these massive interconnected bubbles where the failure in private credit amplifies the valuation crash in tech, and vice versa. It's a feedback loop.
So if that forecast is even close to accurate and the market starts shedding trillions of dollars overnight, the response from central authorities, specifically the U.S. Federal Reserve, it would have to be immediate and desperate. What does Dowd suggest about the Fed's emergency tools to prevent a total collapse?
He is unequivocal on this. The Federal Reserve, believing that they cannot afford a total uncontrolled collapse, will intervene. They will go back to the tools they used after 2008 and during the pandemic, but at a much, much grander scale.
And the sources name two specific tools that will be deployed.
Yes, massive quantitative easing, or QE, and the potential use of yield curve control, or YCC.
Okay, we need to spend a moment here. QE, the printing of money to buy assets. Most people are familiar with that by now. But YCC, yield curve control, is less common, and you could argue much more sinister in its implications. Let's truly define what that is and why it's a form of extreme financial repression.
YCC is a form of aggressive market intervention. The central bank explicitly targets and caps longer-term interest rates, typically the 10-year or 30-year bond yields. So while QE focuses on the quantity of assets they buy to push rates down indirectly.
YCC focuses on the price.
Exactly, it focuses on the price. The central bank basically promises the market they will buy an unlimited amount of bonds necessary to ensure that the cost of government borrowing stays below a certain desired level, regardless of inflation or market demand.
So it completely eliminates price discovery in the bond market. It ensures the government can borrow cheaply, even as inflation might be raging. Who pays the cost for this?
Savers, retirees, pension funds, everyone. YCC constitutes financial repression because it essentially forces real interest rates, that's to read after you account for inflation, into deeply negative territory.
Can you give us an example?
Sure. If inflation is, say, 5% and the Fed caps the 10-year Treasury yield at 2%, anyone holding that government debt is guaranteed to lose 3% of their purchasing power every single year. It makes the cost of servicing the government's massive existing debt affordable, but it does so by explicitly, deliberately eroding the value of capital and savings.
And this intervention, this necessary deployment of QE and YCC to prevent an immediate financial collapse, it comes at a devastating systemic cost. So what is the long-term consequence of these inevitable Fed interventions? How does this connect back to Dowd's core monetary theory?
The consequence is further inevitable currency debasement and subsequent long-term inflation. The immediate solution, this massive money printing via QE or YCC, it solves the liquidity crisis. It prevents the banking system from seizing up in the short term. But it floods the system with fiat currency, guaranteeing that the purchasing power of the dollar, the euro, all the other major currencies continues to erode over the long run. The debt is saved, but the currency is destroyed.
So the immediate solution that's designed to save the financial system ends up being the very engine of the long-term systemic problem inflation. It's a closed loop of destruction where the government is forced to inflate its way out of trouble. And that brings us to the most spectacular component of the current crisis, the AI bubble.
The current artificial intelligence boom is so central to modern market valuations. I mean, it's driving a huge chunk of the stock market's recent gains. So it really demands a dedicated deep dive.
Absolutely.
And Dowd views it as a classic tech hype cycle. Understanding his analysis on this offers some specific actionable analysis for those of you trying to distinguish between real sustainable technology and just pure market speculation.
Okay, so let's unpack the AI situation with the detail it needs. What are the specific structural symptoms of a bubble that the source material cites? The things that are visible in the AI market right now, particularly with the big names.
Well, the sources point to three classic symptoms that you can see today that really mirror the dot-com era. First, we are seeing massive early investment coupled with minimal real returns. The ROI problem.
Right.
Venture capital, public investors, they're pouring billions into infrastructure, GPUs, data centers, compute capacity, all based on the promise of future earnings and productivity gains. But the actual clear-cut revenue streams and the productivity increases you'd need to justify these multi-trillion-dollar valuations, they aren't really materializing yet, not widely across the industrial base.
And this isn't just about a few startups losing money. This is about the entire infrastructure build-out being predicated on adoption rates that might be completely unrealistic. And that leads directly to the second symptom.
Exactly. The second symptom is overbuild and unrealistic adoption timelines. Everyone, from the major cloud providers to specialized AI companies, is rushing to acquire chips and build out this vast data infrastructure for the future of AI. The problem is, if the true, scalable, high-margin applications aren't ready yet, or if mass corporate adoption is slower than anticipated because of integration hurdles or data security concerns.
You end up with a server farm ghost town.
The server farm ghost town. Massive excess capacity. The capital expenditure far, far outpaces the immediate utility.
And the inevitable outcome of that combination, massive front-loaded spending and delayed returns, is predictable.
It's a crash when the financing dries up. When the market, especially that private credit market we just talked about in Section 2, when it realizes that the promised returns are distant, the easy money that has been feeding this whole ecosystem just disappears. And the valuations for the pure play AI companies collapse because the underlying infrastructure costs are gargantuan and the margins are much thinner than people anticipated.
And here's where it gets really interesting, because Dowd isn't just talking theory about the ecosystem. He names specific companies that are in the crosshairs. He predicts they are nearing this crash phase: OpenAI and NVIDIA. Now, you can't just name market giants like that without some serious justification.
You absolutely cannot. For a company like NVIDIA, the analysis cites two powerful signals. The first is already existing credit market stress. The tightening of financing means their biggest customers, the AI startups, the major cloud providers, they're facing higher borrowing costs or restricted access to capital, and that reduces their ability to purchase these massive multi-billion-dollar chip orders.
Okay, and let's focus on that second signal. Observable slowing revenue growth for these major players relative to the expectation. The market has priced in exponential growth for a company like NVIDIA almost to infinity. So even a small slowing of that growth, say 50% year over year instead of the predicted 60%, that's enough to shatter a multi-trillion-dollar valuation.
Oh, completely, because the entire sector is running on pure forward-looking momentum. The moment those expectations fail to materialize, especially when it's compounded by customers who suddenly can't secure financing to continue their build-out, the feedback loop turns deflationary.
So the whole ecosystem is just dependent on cheap, abundant capital.
It's totally dependent on it to fund these massive, expensive infrastructure build-outs. If that private credit spigot tightens, the demand for the hardware slows down drastically, and that immediately puts pressure on the companies selling the picks and shovels. This isn't a failure of the technology itself, it's a failure of the financial structure that's supporting it.
But, and this is an important point, this isn't a blanket condemnation of AI technology itself. Dowd provides a really important, optimistic, and critically strategic counterpoint about future success.
Right.
He emphasizes that the real lasting success of AI will come from specialized niche models, not the current trend of these huge generalized systems.
This is the critical aha moment that you, as a listener, need to grasp for any kind of long-term investment strategy. The current bubble enthusiasm is focused almost entirely on these generalized large language models, the jack-of-all-trades systems that require massive amounts of data and compute power just to answer any question.
And Dowd suggests that business model might be flawed.
Fundamentally flawed because of their staggering operational costs and their generic utility.
So where does the real value lie then?
The real sustainable value, he argues, will be unlocked by specialized vertical AI that's applied to specific high-value niche industries. Think about a specialized AI that can diagnose rare forms of cancer using only pathology slides, or a model that optimizes the logistics for a single complex global shipping network, or one that designs highly specific microchips for very specific functions.
Oh, okay.
These specialized niche models, they offer a clear immediate return on investment and ROI, and they avoid the massive computational overhead and the brutal competition that's inherent in trying to build a general-purpose models for the entire world.
So the general-purpose AI hype may crash, and crash violently, burning through billions of dollars of venture capital money. But the long game, the lasting economic transformation, that will be driven by specialized AI that knows how to solve one or two highly complex, lucrative problems extremely well.
Exactly.
It's a great distinction to make between a speculative asset and a genuinely productive technology. And it reinforces the idea that the bubble bursting is a financial event, not a technological failure.
So we've discussed the geopolitical necessity for distraction. We've talked about the specific financial bubbles threatening a collapse. Now we have to zoom out and look at the foundation they all rest upon.
The big picture.
The big picture. And this brings us to the core concept of Dowd's monetary critique. We are trapped in an inherently unstable, exponential, debt-based global system he labels the inflate-or-die system.
That phrase is so stark, it really captures the entire predicament. We need to clearly explain the underlying mechanism of the systemic trap. Why is it that this massive debt-based global economy cannot survive even a brief period of deflation?
In simple, brutal terms, deflation. a general sustained decline in prices for goods, services, and assets, is the poison that kills the debt system.
How so?
Every economic structure globally, from national debt to corporate bonds to your mortgage, is built on the assumption of continuous, even if it's low, inflation and economic growth. If prices fall, but the amount you owe on your fixed debt remains the same, the real burden of that debt skyrockets. Your income is shrinking, your assets are worth less, but your fixed obligation remains unchanged.
And what does that cascade of rising real debt lead to?
It triggers massive defaults. As asset values fall, that's the deflation loans get called in or companies fail, which leads to widespread liquidations. This then forces more assets onto the market, driving prices down even further, triggering a debt spiral that leads to an immediate economic collapse, a deflationary depression.
So the system has just reached a point where the total global debt is so astronomical that even a minor correction, a non-inflationary correction, would trigger this systemic implosion.
That's the argument. The system must generate inflation. It has to constantly devalue the existing currency just to ensure that the existing mountain of debt remains payable in cheaper, inflated future dollars.
So inflation isn't a side effect or a policy mistake. It's the only lifeline preventing instant systemic death.
Exactly. The entire architecture of modern global finance is engineered to choose inflation over collapse every single time. And because the debt grows exponentially, governments constantly issue new debt to service old debt, the amount of inflation required to sustain the system also grows exponentially.
And based on this fundamental trap, Dowd foresees a predictable, repeating cycle that he thinks will continue indefinitely until the system is either fundamentally reset or it just totally collapses. Let's detail that three-step predicted cycle for everyone listening.
Okay, so when the bubbles burst, as predicted in Section 2, Step 1 is the asset deflation and liquidity crises. That's the moment the market experiences that 40 to 50% drawdown we discussed, where prices fall and credit completely seizes up. This is the die moment, the painful correction that's required by economics.
But that die moment is politically and financially intolerable, so it's immediately followed by the inflate reaction. Step 2 is government intervention and massive money printing. This is the Fed and other central banks deploying that unlimited QE and that yield curve control we talked about.
This is the system saving itself from the brink. It proves the inflate-or-die thesis is true in real time.
And step 3 naturally follows from that. The injection of that vast new liquidity, often measured in the trillions, leads directly to a rebound with renewed inflation. Prices stabilize for a moment, asset prices recover, but the crucial point is that the purchasing power of the currency has been permanently degraded, even further than before.
And that leads us right back to a new cycle of speculation and eventual collapse, which will require even more printing the next time. It's a self-perpetuating debasing cycle.
This analysis suggests that the next round of massive money printing, the next massive QE operation, is inevitable. The market crash predicted in Section 2 virtually guarantees it. So the key variable isn't if it happens, but how it's justified to the public. What are the 3 excuses Dowd believes will be used to justify the next politically palatable round of QE?
The sources cite 3 potential politically acceptable triggers that demand these massive, unified, national-level spending efforts that can bypass standard budgetary controls. And those 3 are war, AI competition, or another pandemic.
Okay, let's analyze why these specific justifications are so effective. War, as we covered in Section 1, is the ultimate distraction and justification for unlimited spending. It's often framed as national survival, and it immediately silences all debate over government spending limits and deficits.
Then you have AI competition. It serves a very similar strategic purpose. If you frame the need for massive QE as an economic and strategic necessity against global rivals like China, a new kind of space race, it justifies trillion-dollar subsidies and massive infrastructural investment in technology.
So it's not seen as rescuing banks.
No, it's seen as funding the future and protecting your national competitive advantage.
And a pandemic, as we saw so vividly in 2020, allows for an immediate, unified global response. It involves massive fiscal and monetary stimulus, unlimited emergency spending, and liquidity provision that is politically difficult, if not impossible, to argue against in the moment. The public demands a solution, and money printing is the instantaneous tool governments use.
But the core reality, which Dowd emphasizes repeatedly, is that the justification itself is secondary. It is merely the camouflage. He reinforces that printing money itself has become the system's indispensable lifeline, regardless of the specific emergency used to trigger it.
So the specific crisis is just the politically acceptable vehicle for the necessary inflation.
It's the vehicle. This is the intellectual wrestling match you have to have with these sources. Dowd isn't claiming the crises are fake. He's claiming they are the politically acceptable catalysts for the monetary policy that was already predetermined by the unsustainable debt burden. They are the mechanisms that allow central banks and governments to perform the life-saving inflation that's necessary to keep the debt system operational without triggering an immediate public revolt over the devaluation of their savings.
It's cynical, but within the confines of a debt-based system, it's also, perhaps, mathematically necessary.
So, given that we are trapped in a system where inflation is the only necessary outcome, and central banks are fully aware of this unsustainable predicament, we need to look for signs of a potential long-term exit strategy.
An escape hatch.
An escape hatch. And Dowd points to a highly significant signal regarding preparations for a major monetary reset, a shift away from the fiat system that inevitably requires this perpetual debasement.
And that signal is the behavior of the central banks themselves, their physical asset accumulation. You would expect them to trust the very system that they manage, but the data tells a completely different story.
It really does. The source highlights the record gold accumulation by central banks globally, specifically noting that central banks in emerging markets, China, Russia, India, Turkey, they are massive, consistent net buyers of physical gold. They're accumulating it at paces we have not seen since before the 1970s.
And this is physical gold being moved into national reserves, right? Not just paper transactions.
Physical bullion, exactly.
So why is this gold hoarding so significant? What is the implication of this massive activity, particularly if they are preparing for some kind of reset?
Well, the hypothesis is profound. This accumulation signals a preparation for potentially returning gold to a central role in the monetary system, or at least using it to back some future iteration of the currency system.
Why gold?
Gold is the ultimate non-sovereign hedge against fiat currency debasement. If the current debt system collapses under its own weight, or if the US dollar loses its status as the world's primary reserve currency, which would happen due to the massive inflation that YCC guarantees, having physical gold gives those central banks a trusted, tangible, universally accepted asset on which to base a new system. It restores global confidence where pure fiat currency has failed.
They're stocking the pantry for the post-dollar world.
That's a great way to put it.
That's a powerful suggestion, that the same people who are implementing the inflate-or-die strategy are simultaneously preparing their national balance sheets for the moment that strategy finally fails. So we have these massive global forces at play: war for distraction, bubbles bursting, central banks secretly preparing for a monetary overhaul. Given this dangerous landscape, what is Dowd's specific practical advice for individuals?
His advice is pretty straightforward, actually, for personal protection against this systemic inflation risk. He advises holding some gold as protection against currency debasement and systemic failure. It serves as a kind of financial insurance against the inevitable long-term inflation that the inflate-or-die cycle guarantees.
But this advice, it comes with a crucial caveat that kind of tempers the expectation of a romanticized, full return to the gold standard immediately. What is the impracticality warning he gives about gold?
He explicitly notes that gold is impractical for transactions in the modern economy. While it's excellent for preserving wealth over the long term, and it provides that insurance value we just discussed, we aren't going to be buying groceries or paying our bills with fractional gold units anytime soon.
So it manages expectations.
It does. It emphasizes that gold's primary utility in this context is as a store of value, a non-fiat asset anchor against systemic volatility, not as a medium of immediate exchange.
You know, this entire analysis of systemic risk, geopolitical conflict, collapsing bubbles, it can be terrifying. It really can. It suggests financial Armageddon is just around the corner. But Dowd concludes the analysis on a surprisingly optimistic note.
He does?
He offers this cautious optimism that shifts the focus from fear to strategic planning, particularly for younger generations who might feel completely locked out of asset ownership today.
Absolutely. He views the coming crash, that predicted 40 to 50% drawdown, not as an end, but as a necessary massive buying opportunity, a generational wealth transfer.
Explain that.
When asset prices are corrected that drastically, and quality assets, whether they're real estate, productive companies, quality stocks, when they're distressed and being liquidated, it represents a chance for those who have capital reserves, even modest reserves, to purchase those assets at significantly discounted realistic prices.
And that's the real strategic aha moment here, isn't it? The narrative shifts entirely. The chaos, in his view, is the necessary cleansing that reintroduces affordability and opportunity into markets that have been just grotesquely inflated by decades of easy money and financial repression.
Right. For those who are prepared to wait out the volatility and maintain liquidity, it's an opportunity to build wealth on fundamentally stronger, corrected foundations, rather than just chasing bubbles.
It connects the whole thesis. The system must inflate to survive. The moment it stops inflating, it crashes, which is painful, but that crash is the only way to correct the unsustainable asset prices created by the prior inflation.
The crash is the chance.
We've covered a remarkable amount of ground. We've connected the highest levels of global politics to the most practical issues of personal finance, all through this alarming yet structurally sound lens of Dowd's analysis.
So for you, our listener, here is the essential takeaway kit from this deep dive. First, internalize the geopolitical thesis that major world powers are using conflict and external enemies, the crisis of distraction, as a deliberate cover to manage unresolvable internal debt and demographic crises. The chaos serves a structural purpose.
Second, you need to internalize the sheer scale of the financial threat. We are talking about a simultaneous convergence of massive bubbles housing, opaque credit, and AI valuations, leading to the potential for a 40 to 50% stock market drawdown, a correction comparable to the dot-com crash and the 2008 financial crisis combined.
And finally, recognize the fundamental monetary trap we're all operating in, the inflate-or-die system. Because the debt burden is so massive and systemic, deflation is impossible. And that means that every crisis will inevitably be met with massive money printing, guaranteeing the long-term debasement of currency, even as asset prices temporarily collapse.
And this brings us back to the ultimate question posed by the system's lifeline. If the next round of massive currency printing is inevitable to prevent systemic collapse, and central banks are signaling a major shift by hoarding physical gold, the only real uncertainty is the political vehicle that's used to justify the printing, the vehicle that allows the state to hide the inflationary cost.
Dowd identified 3 potential justifications for the next massive QE war: AI competition or another pandemic. If the system has to choose one, and it needs a justification that is both politically feasible, generating broad public support for unlimited spending, and economically effective in masking the monetary lifeline, which of those 3 is the most likely candidate to force the next necessary round of massive currency debasement?
Which crisis is the system truly prepared to leverage globally for a structural financial reset? Something to mull over as you watch the headlines unfold. And a perspective that I think fundamentally changes how you view global events. Think strategically, not just reactively.
Welcome to the debate. The material we are examining today paints, well, one of the starkest pictures of systemic risk we've seen in years. It's describing a kind of perfect storm, a profound convergence of deep economic fragility. And we're talking about massive, converging bubbles in housing, speculative AI, and overextended private credit, colliding with this rising global geopolitical disorder. Specifically, Europe's debt crises and China's fundamental demographic decline. The warning is, it's severe. An anticipated 40 to 50% stock market drawdown, equating the current vulnerability to the combined financial weight of the dot-com collapse and the 2008 crisis.
Right. If that analysis is even half correct, the stakes are nothing short of existential, both financially and, well, politically.
Absolutely. And that intensity leads us to the core disagreement we need to unpack today, which is really about causality. We both agree a major crisis is coming, but what's driving the bus? Is the escalating global disorder and the threat of conflict, whether that's a potential Taiwan action or the push toward conflict in Europe, is that fundamentally a symptom of this underlying inflate-or-die debt-based economic system? Or is it an independent and primary driver, a calculated political strategy designed to mask that systemic failure and justify the currency debasement that policymakers know they have to deploy? And so for my part, I hold that the economic mechanism is the primary, inescapable engine. The geopolitical conflict, the strategic competition, that's all powerful, maybe even necessary political justification, but it's deployed to service that fundamental, structural financial need. The system's life depends on inflation, and everything else follows from that.
And I come at it from a different way. While that financial fragility is a necessary precondition, I'd argue that the deliberate political strategy of weaponizing distraction and manufacturing external enemies to maintain internal social control. That is the key initiating factor. That conscious choice is what drives the timing and the severity of the monetary response. It's the political strategy that defines the crisis, not just the balance sheet.
I see why you think that, but let me give you a different perspective, one that's really rooted in the structural mechanics described in the material. The global economy, tethered to these vast government and private debt loads, has become an inflate-or-die machine. It just cannot withstand a genuine period of deflation or deleveraging without a catastrophic collapse. And that structural constraint is the central driver of all policy choices. When the inevitable asset deflation and liquidity crisis happen, which they are, as these housing, AI, and credit bubbles converge, the cycle mandates immediate and truly massive government intervention to prevent a total implosion. And this is where we have to talk about the technical tools. This convergence of failures ensures a crash so large, it requires not just quantitative easing, but potentially yield curve control, YCC, which is the ultimate move where a central bank caps long-term rates just to prevent the entire sovereign debt structure from imploding. The economic necessity to print, to debase the currency is absolute. So the future use of war, of existential AI competition, or pandemics, they're just the next necessary justifications for what the debt structure already mandates. As the material makes clear, printing money itself has become the system's lifeline. The political theater is just subservient to that unavoidable financial requirement.
That's a compelling argument, and it's based on structural necessity. I wholeheartedly agree that the debt system is profoundly fragile. That's not controversial. But where I part ways is in defining the initiating moment. The fact that the economic structure makes some monetary response necessary doesn't dictate the highly specific, aggressive geopolitical choices we're seeing, nor does it dictate their timing. My focus is on the political imperative, the need to maintain control in the face of these deep, undeniable internal crises, particularly the demographic collapse and pension solvency crises that are facing Western nations and China's aging population woes. That political imperative is the initiating action. Conflict, therefore, isn't some random outcome of economic stress. It's a calculated, conscious policy tool deployed strategically to distract populations from internal failures and to facilitate a financial and political reboot under the cover of a national emergency. The material is very pointed here. It cites Europe pushing toward conflict explicitly to distract from pension insolvency and China using high-stakes nationalism around Taiwan to mask its own severe internal economic slowdown. This reflects it's a deliberate pattern. When economies falter, governments reach for external enemies to maintain cohesion. The political strategy defines the crisis, and it precedes and informs the timing of that massive monetary response. So if we accept your premise that the economic crisis is truly paramount and purely systemic, then why the need to cite such specific, geographically distinct, and deliberate geopolitical actions? The move by major powers toward creating external enemies and potential conflict suggests a proactive, top-down strategy. These leaders are choosing to utilize nationalism and war as the means of managing inevitable social unrest before the ultimate monetary tools like full-scale YCC are deployed. They're engineering the environment. The choice to lead with war rather than some lesser form of distraction suggests the political failure is the one that sets the catastrophic timeline.
I'm just not sure I buy that because I think it misidentifies the priority and crucially the scale that's required here. Of course, leaders use the most effective levers available, and war is certainly a powerful lever for social control. But the underlying structural need for printing is absolute because of the sheer volume of global debt. The geopolitical distraction simply provides the easiest political cover that the public will tolerate. And let's focus on the scale of the financial collapse we're discussing, a combined dot-com plus 2008 crash. This is not a moderate cyclical recession you can fix with a small dose of liquidity. This requires currency debasement on an unprecedented, almost unimaginable scale, trillions upon trillions. If policymakers just came out and said, we need to save the pension funds, the public outcry would be instantaneous. But why would they choose war or massive international competition as a justification if a lesser excuse would work? because only crises of that scale, major wars, existential geopolitical competition, justify the trillions in new money needed to counteract a crash of that magnitude. The severity of the impending financial catastrophe isn't just a backdrop, it dictates the necessary severity of the political distraction. The political crisis has to be proportionate to the financial necessity it's meant to cover.
That relationship between scale and justification is valid, I'll grant you that. But it still frames the political strategy as merely reactive, a necessity dictated by finance. I'm arguing the political strategy is proactive in its selection of which necessity to pursue. Look at the specific drivers cited. The demographic crisis in Europe isn't some subtle background factor. It's a ticking time bomb for pension obligations. So governments are choosing to preempt this internal collapse by diverting public attention and reallocating resources under the guise of an external threat. They are making the choice to weaponize nationalism now, not waiting for the final economic death rattle. This suggests the political decision to manage internal decline by creating external conflict is the primary initiating force that then creates the necessary conditions, the national emergency, to deploy your structural monetary tools.
That brings us back to the market itself. Let's look at the AI bubble, which the material explicitly flags as a major vector of fragility. We are seeing massive early investment driven by speculation and credit, yet with minimal immediate returns. And analysts are predicting a crash is imminent for companies like OpenAI and NVIDIA because of overvaluation and high burn rates. This is a classic tech hype cycle operating purely on, speculative depth and unsustainable valuations. It's a pure economic mechanism. It will crash violently, regardless of whether Beijing invades Taiwan tomorrow or not. Doesn't the existence of a colossal debt-fueled bubble like that, entirely managed by market and credit mechanisms, prove that the systemic economic weakness is the overriding primary force?
That's a compelling argument for the fragility inherent in the system. But have you considered that the aggressive inflation of the AI bubble serves the exact same political purpose as the push toward war? This AI hype cycle isn't just an organic market phenomenon, it has been nationally prioritized, strategically inflated by governments. It channels vast pools of global investment and national focus into a high-tech competition narrative, the race for technological supremacy, which the material explicitly suggests is one of the available justifications for the next round of massive printing. Think about the strategic framing. If the crash hits, the government won't let the core technology fail, precisely because it has already been framed as a matter of national security and economic competition with China. The strategic promotion of AI hype and the subsequent expected bailouts and printing to save the industry or win the technological war, that becomes a politically sanctioned economic distraction. The financial structure facilitates the political goal of creating a narrative that justifies sovereign intervention. The political strategy directed the investment flow in the first place, ensuring the bubble formed in a strategically relevant sector.
I acknowledge the political utility of the AI narrative. It's certainly a convenient hook. However, the size of the AI bubble, its overextension in private credit, and the housing debt that often collateralizes these investments, that's the fundamental instability. The politicians didn't create the speculative drive, they are merely taking advantage of the inevitable speculative failure that the debt environment facilitated. The mechanism of failure is economic. The justification for the resulting bailout is political. One drives the other.
Well, if we step back and look at the preparations being made, we might get some clarity on the driver. Let's shift to the monetary reset signal. The source material highlights central banks' record gold accumulation, a clear signal they're preparing for a massive monetary shift. So does this activity reflect preparation for a chaotic economic collapse caused purely by internal debt failure, your systemic view? Or does it reflect preparation for a global financial shift that's necessitated by geopolitical fragmentation and conflict? In a world of deepening disorder and weaponized currencies, confidence in sovereign fiat systems is breaking down because of external political pressures. Gold is expected to return to a central role precisely because the world is splintering politically.
I come at it from a different way when interpreting the gold accumulation, though I agree it signals a pending reset. To me, that reset is necessitated by the system's structural need to inflate itself out of this coming dot-com/2008 scale crisis. The gold accumulation is protective action against the inevitable currency debasement caused by the massive quantitative easing and eventual yield curve control required to prevent collapse. If you have to print trillions, confidence in the dollar and the euro will just evaporate. Central banks are preparing for the death of fiat confidence because they know they are structurally compelled to inflate to survive the debt mountain. Gold is protection against inflation, which is, ironically, the system's absolute lifeline. Geopolitical stress certainly accelerates the timeline, maybe by years, and it provides the convenient narrative, but it doesn't change the core necessity of the action. That's determined by the size of the outstanding debt. The central banks are buying gold because they are about to deliberately destroy the value of their own currencies in a final attempt to service that debt load.
See that as a difference in emphasis. I believe the geopolitical chaos provides the permission for the currency destruction. The crisis is not just one of internal debt management. It's a crisis of sovereignty and international trust. Central banks anticipate a world where national blocs matter more than globalized financial structures, a world engineered by the political choice to fragment and create enemies. In that politically fragmented future, gold offers neutral protection that fiat doesn't. The political fragmentation dictates the nature of the reset.
To summarize my position, the global system is fundamentally defined by its debt constraints and the structural necessity to inflate the money supply at all costs to avoid utter financial ruin. Geopolitical tension, the creation of external enemies, and these hyper-competition narratives, whether it's AI or military, they are powerful, politically convenient levers. However, they are ultimately deployed to service the overriding, structurally dictated need for liquidity and currency debasement. The financial requirement is the engine. The political crisis is just the chosen fuel used to justify the necessary action.
And my summary is that while the system's underlying fragility is an undeniable precondition, it's actively exploited by governments using the calculated strategy of creating external enemies, be it through kinetic war or competitive tech hysteria, to maintain social control and manage severe internal decline. This means the political choice, the decision to weaponize distraction and initiate fragmentation, is the primary driver that dictates the necessity, the timing, and the severe nature of the monetary reset.
Both views, I think, strongly